Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly newsletter. Today's date is the 13th of January. Let's dive into the week's stock market news. European markets rise amidst inflationary pressures and rate cut speculation. European stock markets posted gains last week, with the Pan-European Stocks Europe 600 index closing 0.65% higher in local currency terms. The positive performance was driven by continued investor expectations that the European Central Bank will implement interest rate cuts in the near future, despite recent uptick in inflation across the Eurozone. Italy's FTSE MIB led the charge, surging 2.82%, followed by Germany's DAX, which gained 1.55%, and France's CAC 40 index, which added 2.04%. The UK's FTSE 100 index also participated in the rally, albeit with a more modest increase of 0.30%. Meanwhile, the UK bond market experienced significant volatility. The Treasury sought to reassure investors and reasserted its commitment to fiscal responsibility following a sharp sell-off in the pound sterling and UK government bonds. This sell-off pushed the 10-year gilt yield to 4.8%, its highest point since August 2008. The rise in yields reflected a broader trend of increasing bond yields globally, fueled in part by a more hawkish outlook for U.S. interest rates and by concerns surrounding certain proposed fiscal policies from abroad. Investor anxieties regarding the UK's debt burden and the current government's capacity to manage public finances while enacting its budget also contributed to the upward pressure on gilt yields. Reports emerged that the Chancellor of the Exchequer urged cabinet members to develop strategies for stimulating economic growth. Economic data from the Eurozone presented a complex and somewhat contradictory picture. December's year-over-year inflation rate accelerated to 2.4%, up from 2.2% in November, primarily due to rising energy and service costs. The core inflation rate, which excludes volatile components like energy and food, remained steady at 2.7%. Retail sales exhibited minimal growth in November following a decline in October, while the unemployment rate remained at a record low of 6.3% in November. The ECB, in its latest economic bulletin, maintained that the disinflationary process is progressing as anticipated. The central bank also indicated that most underlying inflation measures suggest a stabilization at the ECB's 2% medium-term target. Adding to the dovish sentiment, one policymaker was quoted suggesting that the ECB should avoid being overly cautious about potential future inflation shocks, emphasizing that running the economy below its potential could weaken its ability to respond to unforeseen events. Further fueling expectations for rate cuts, another ECB official stated that a continued pullback in inflation, as anticipated, would justify a move towards a neutral interest rate without delay by the summer. Now our insight into alternative markets. Private equity in Italy. Growth in number, decline in value in 2024. The activity of private equity and infrastructure funds in Italy recorded a significant increase in the number of M&A transactions in 2024, albeit with a contraction in terms of overall value. This is what emerges from the latest AM&A barometer, which depicts an evolving market, characterized by a greater focus on the mid-market and an increase in add-on transactions. In detail, Funds announced 606 transactions in 2024, representing 44% of the total M&A deals in Italy. 1,365 transactions, up from 40.3% in 2023. However, the total value of these transactions stood at €30.4 billion, equal to 47.6% of the total, €63.9 billion, down from 65.7% recorded in the previous year. This dynamic is mainly attributable to a greater concentration of investments in the mid-market, with a growth in the average value of transactions in this segment. Despite an increase in the number of mega deals compared to 2023, their average size was smaller, negatively influencing the overall market value. There was also significant growth in add-on transactions, that is, acquisitions made through companies already in the portfolio, which accounted for 45% of the total deals conducted by funds in 2024, compared to 32% in 2023. The industrial sector remains the favorite of private equity funds, although it recorded a slight decrease in terms of percentage incidence, from 28% to 24%, due to a general slowdown in industrial production. On the contrary, the consumer and technology sectors saw their share of transactions grow, from 15% to 16% and from 13% to 17% respectively. As for the entire M&A market, the industrials and chemicals, 26%, retail and consumer, 14%, technology, 13%, and energy and utilities, 10%, sectors remain the most active. Cross-border transactions involving Italian companies increased to 280, for a value of approximately €14.3 billion, with the United States, Germany, Spain, France, and the United Kingdom as the main destinations. Despite the solid numbers, 2024 was a complex year, characterized by numerous interrupted or postponed transactions due to company performance not in line with expectations, unfavorable financing conditions, and uncertainties on the international landscape. The forecasts for 2025, however, are positive, with an expected economic growth of 0.8% of GDP and high liquidity in the system, which should encourage a further increase in investments by private equity funds. In conclusion, companies are expected to be increasingly driven to make technological evolutions related to artificial intelligence. Furthermore, the reorganization of target markets and changes in consumer preferences will require increasingly integrated services between technology and experience. The transactional lever will continue to be perceived as a determining element of the repositioning and development strategy of companies, also through the construction of strategic alliances for sectors and production chains and the simplification of business models. These elements, combined with the expectation of a less restrictive monetary policy, lead to a forecast of very lively M&A activity, with growth that could be double-digit starting from the second half of the year.
Thank you for listening to this episode of Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.